Don't listen to the 17-year-old pimply YouTuber who is a millionaire or who claims to be a millionaire, riding in a rented Ferrari, living in the parents' basement. When they say cash is trash, don't listen to them. You do have to own some cash, okay? So let me just say cash is not trash. But again, if you understand where they're coming from, if you understand inflation, knowing that the value of your cash now is going to be less than the value of that same cash in the future, almost everybody here, you understand what inflation is. Crypto bros and sis might say it's because the government is just printing money, printing money, printing money. It's called quantitative easing. So there's more cash in the system than products for the cash, so the value goes up. It's a bit complicated. There are many other things that contribute to inflation actually. Is it a good time to invest? Should you buy the dip? I mean, with the recent downturn in the stock market, many doctors and obviously professionals are wondering if it's a good time to finally take the plunge and start investing. But what if I told you that many people are jumping into the stock market but have no idea what they are really buying and could end up losing a lot? It sounds crazy, right? But it's happening every single day, even among high-earning professionals like medics. Look, let me show you how to avoid that. I'm Dr. Egwim. I'm 20 plus years investor, ex-salaried NHS GP, and the founder of MoneyWise Doctor. And our resources have already helped over 10,000 medics make smarter financial decisions. And what you're about to watch is a rare behind-the-scenes look into one of my most requested investment masterclasses for doctors. This session was originally part of a 4-week deep dive into investing that I thought a small group of UK-based medics. Cost a lot of money to attend, and many of doctors who have joined have gone on to become confident and safe investors. But for this weekend, I wanted to give you this powerful section completely free. In this video, I'll walk you through why cash is not trash, despite what the finance bros say, what earnings, dividends, and book value actually mean in plain English, and how to avoid overpaying 10 times more than what a stock is valued at, even when it's popular. And to make it all make sense, I'll use practical examples that you can understand clearly. You will never look at investing the same way again. So grab a cuppa, take notes if you want to, and let's just dive into it. I've got a whole session on index fund we'll look at, but let's look at basically the understanding different types of investment vehicles. Now, if you look at the sort of like the little pie chart I've put there, it's just to show you different asset classes. It's by no means all the asset classes existing in the world, but it's just to give you a general idea of asset classes. I've added cash. I added cash just last minute. I left it there like it's cash really an investment, but I always teach people to have an emergency fund. And I thought, no, if I don't add cash, I might forget to mention to you that you do have to own some cash. Don't listen to the 17-year-old pimply YouTuber who is a millionaire or who claims to be a millionaire, riding in a rented Ferrari, living in the parents' basement. When they say cash is trash, don't listen to them. You do have to own some cash, okay? So let me just say cash is not trash. I like being able to write some typing. Cash is not trash. But again, if you understand where they're coming from, if you understand inflation, knowing that the value of your cash now is going to be less than the value of that same cash in the future, almost everybody here, you understand what inflation is. And if you don't understand, feel free to pop it inside the chat box and I'll circle back and talk about inflation. But basically, what it means is that if you just had £100 and you just put it under your pillow for the next 10 years, what that £100 is able to buy is very likely going to be far less or a bit less than what it can buy now. So that's because of a number of factors, and the crypto bros and sis might say it's because the government is just printing money, printing money, printing money. It's called quantitative easing. Borrowing money, printing money, printing money. So there's more cash in the system than products for the cash. So the value goes up. But it's a bit complicated. There are many other things that contribute to inflation, actually. But the bottom line of it, what you need to understand is that when it comes to inflation, it means that the value of your money now is not as what it will be in the future. So inflation is the reason why I don't hold more than a percentage of my portfolio in cash. I try not to keep more than my emergency fund. Yeah, and Amomi has raised an important question, so I think we should address it now. So inflation is the main reason why you are investing. That's why you want to invest. Inflation is the main reason why you don't just put your money in the bank. And inflation is the main reason why if you just buy bonds, because bonds used to be like, oh, this is the only investment. If you go back like 100 years before the stock market became so popular in the 1920s, leading to the 1929 crash, people thought investment was just buying bonds of companies, bonds of the government, and the bond they pay you a premium. So they pay you with these coupons twice a year. But then stock market became popular. Bonds, most times inflation usually leaps over them. Like as at yesterday when the market closed, so yesterday Friday, I think UK bonds, UK government bonds, we call them gilts. Again, that's one of the terms I've put in that resource I sent to you. Guilt. So it's called guilt, and I don't want to go into the history of why it's called guilt, the paper that had the gilded edge and all that. But if you hear guilt, just replace it in your head with UK government bonds. So that makes it less confusing. And I know your banker friend might say guilt and say things like LIBOR rates, but just think about it as bonds. Bonds tends to be outpaced by inflation most of the time. Not all the time, but most of the time. So that's why we invest in things like stocks and other things as well. All right. So let's go back to types of investments and I'll address the emergency fund now. Number one is cash. When we talk about cash, we talk about the money in your bank, money in a maybe high yield savings account, money that if you want it within 24 hours, you can get it. That is what we refer to as cash. And why do you really need to hold any cash? I don't want to answer this question because I know a lot of people here have already answered it, either on my podcast or in our one-on-one session, in our group session. So can someone tell me why do you need to leave cash and what the cash is called and how much you can leave or how much you leave? Tell me what you do.
Yeah, so the cash should be like your emergency fund. So money that is easily accessible should you need money for an emergency. Um, Ideally it should be like your expenses in 1 month by 3 to 6 months. So for me, I did 6 months.
Impressive.
Yeah.
Yeah, okay, thank you. So that's impressive. So basically, your emergency fund, I'm not saying that's the only cash you keep. You can keep cash for many other reasons. But this is, if you don't keep any cash at all, this is the one you should definitely have in your portfolio. So emergency fund is 3 to 6 months worth of your living expenses. And for some people, it's 12 months. Sometimes I feel more comfortable having 12 months because I don't have a salary job. I don't have an NHS pension, and even though I've got some investments and I've got things and all that, but also I don't have any sort of like sick pay. So I like to keep an emergency fund that is quite a good amount. But I usually say to people before you start investing seriously, try to have at least 3 months worth of your living expense. So that's the answer to that question, Wumi. At least 3 to 6 months worth of your living expense. If you don't know what your living expense is, that's where to start. There's that video which we'll share as well in the comments, and I've also uploaded for you in the resources I shared. It's 7 things you need to do before you start investing, and one of them is have an emergency fund, have income protection, life insurance, understand how to invest, which you're learning now. So emergency fund should be 3 to 6 months worth of your expenses. How to find out what your expenses are is quite simple, really. It's hard to do because most times we are every day we are busy, we are going. But if you can bring out an hour or 2 hours, sit down, and you don't have to do this forever. You can do it once a year. Sit down, look at your credit cards, look at your bank statements, look at your checkbook if you still use checks. Find out how much do you typically use in a month. And if you're not sure, take the average of 12 months to figure out. And someone yesterday, in my seminar yesterday for a charity group, they said it was your salary. Someone said it's your salary times 6 months. And I said, no. Your salary for 6 months is not your emergency fund, it's your expenses, whatever you need. You think about your energy bills, your car payment, if you've got car payments, your house payments, if you use rent, the mortgage, your children's, if you've got children and you're paying for them to do karate, taekwondo, and cello lessons or violin lessons and all that, figure out how much do you really need. And of course, if your children can do without the cello lessons. Maybe it might not be part of the emergency fund. Once you figure out what it is that you spend in a month, multiply it by 3, or I can go the other way, check what you do in 12 months, divide it by 12, and that gives you 1 month's worth. Then multiply it by 3. That's your emergency fund. Does that make sense, Wumi? Does that clarify your point?
Yes, it does. Thanks. Yeah.
All right, that's brilliant. Okay, so I want us to all move at a pace that everyone is everyone is following, so that when we get to things that are a bit more technical, we can all be there. So that's good. Now, apart from keeping money in cash, you can also keep money in cash for other reasons. Obviously, if you have somebody, your child is planning to go to school soon, you're about to make an expenses, you have a wedding. I know someone has an exciting wedding coming up soon. You have a wedding, or you have a party, or you have a purchase you're planning to make. You're planning to buy a house. Your money should not be in the stock market. It should be in your lifetime ISA or wherever it should be. If it's not your first house, it should not be. If it's not your first house, you can't use the lifetime ISA. But if it's your first house, you can use the lifetime ISA. Some investors who are sophisticated, they keep cash when they want to make a big purchase. Like I know that Warren Buffett, Berkshire Hathaway, their company, they are sitting on about $180 billion worth of cash, if not more. I don't tend to suggest that for beginner investors because I feel like time in the market, so the time you spend in the market beats time in the market. Obviously, if you're investing in index fund and all that, there's no need to time the market. You can just buy good companies, invest in index fund, and then you settle down. And also, I've not really had a time where I sat down and I was thinking, oh, I'm going to save some money because I think there's a crash coming. Everyone knows there will be a stock market crash, but nobody can say with any degree of accuracy consistently when it's going to be. And you still see in the history of stock market crashes that stock market crash is not news. It's just good for business news. They like to use it to keep us entertained and excited and frightened and all that. But crashes happen. Bubbles happen. It's just the nature of the stock market. There are crashes, there are bubbles. It's just being able to do some consistent investment, knowing what you're doing, means that you're more confident to live through that period. And you don't become greedy when everybody's greedy. So I'm a bit fearful when people are greedy. I'm not actually running and buying a lot of things when the market is bubbling. It's the other way around. When people are more fearful, it's easier for me to find bargains. It's a bit tough sometimes to find bargains when the market is booming because I'm looking for a bargain. I'm looking for a discount. I'm looking for that, what I call margin of safety. All right. So that's cash. I'll come back to margin of safety when we talk about valuation. I'm just going to pack it here. So that's cash as an asset. Now, there are the other asset classes. There's common stock. It's just basically the shares of a company, the shares of a business. Again, let's go back again to basics to help us understand this thing. When we talk about common stocks, it's not a paper. It's not something on the screen that you just see. It is part of a business. You own part of a business. Now, let's think about it this way. Yes, let's say Maryjane, you own a business. I know you're a doctor, you own a hospital, let's say, and the hospital itself is a business. You have staff that are generating some income from the hospital. It's a private hospital. All you do there is hip replacement and knee joint replacement. So you're even excited that the Labour government is about to hand you quite a lot of business very soon. So it's generating some income. It is a business. But let's say there are 20 people who invested into that business. 20 people. So there's you, there's your partner, I mean your husband or your spouse, and then you have like maybe your business partners, you have other surgeons who are part of it, and you guys are in a nice area of London. And then you have an investor who just invested money, but they are not part of the team running it. But basically, there are 20 of you who brought in money and you own that business. I'm going somewhere with this. Let's say that the business is generating every year, is generating a total of £1 million. So let's just use 1 million for ease of calculation. And for it to generate £1 million, it means that every year you're doing at least 100,000. So by the end of the year, you're generating about £1.2 million or thereabout. Follow me on this. Now, along the line as you go, this business is valued because of the amount. Remember what we said at the beginning. Remember those cows and those poor fowls we're talking about. Your business, the egg is generating, the milk is generating is the 1 million pounds. That's a lot of milk is generating. But that is not the cow, that is not the fowl, that's not the chicken, it's still there. So that's the business. But someone comes and says, I want to buy this business off you. And Maryjane, will you agree to sell that business for 1 million pounds? Okay, does someone want to make a go? If you have a business generating 1 million pounds per year, will you agree to sell it for 1 million pounds? Yeah, Suraj.
No.
No. Okay. Obviously, this one seems obvious, right?
Yeah, it's obvious, obviously, because that's the business is able to generate that much cash flow without the value of the business itself, the valuation of the business itself. So I won't sell it, definitely not.
Absolutely. So that is obviously from the words you're using, cash flow, you understand where I'm going. So I made the obvious examples. Thank you so much, Suraj. I made the obvious examples so that when you move forward, you see how ridiculous it is for people to go and invest in the stock market without even attempting to establish the value of the business, or even when it's clear that the business is overvalued. They don't care. Oh, it's popular. We're buying it. The PE ratio is 1,000. How are you going to get your money back? Oh, anyway, let me not get too excited. So Maryjane's hospital is making 1 million pounds. She will not sell it for 1 million, obviously. Now, will she sell it for 10 million? Maybe we can talk about that. You see, it's getting a bit interesting now because the investor is saying, I want to buy it for 10 million, but I'll not pay you all the 10 million now. I'll pay you 1 million per year for the next 10 years. That's VC type of stuff. But basically, the idea to understand is that the hospital itself is the business. The 20 people who own this hospital, they have a say in when you sell it. The 1 million pounds you make per year, they have a share of the profit. Does that make sense? Yes. So they have a share of that 1 million pounds. So let's just say 1 million pounds. You make 1 million pounds every year. I'm using hospital because I know that a lot of us here are medical. Well, everyone here is medical, so you understand what I'm saying. So that business is generating 1 million pounds per year. And you say, at the end of the year, I'm going to take the 1 million pounds and distribute it to, the shareholders. Someone who is quick with maths, I'm sure you figured out it to be 50,000 pounds each person, assuming they are equal shareholders. Do you get that so far?
Yes.
Excellent. Now, why we are making it all that simple is because when it goes up to shares, it's the same thing. It's just a bit more complex. Now, we're all equal partners in this business. We own this company together, and the shares will go 20 pieces. So if you get 1 million pounds, we have to share it. You get 50,000, I get 50,000. But again, when it comes to public companies, we don't all own the same amount. Sometimes, I'm not talking about index fund now, but the same principle applies to index fund. But sometimes you own one share, like a share like Berkshire Hathaway. Some of you might not know there are some shares that cost quite a lot. Let me tell you the price of Berkshire Hathaway. So Berkshire Hathaway, one single share is 671,750 USD. So that's one single share of Berkshire Hathaway. So anybody that owns that share owns a part of that business. So think about it the same way. Your hospital, maybe somebody is the CEO and the founder, and then the other people, they own maybe a larger portion of the company, and then there are other people who just buy 1%. Some people buy 2%. Some people brought a little more money. Some people brought less money, and these are all sort of like, there are some people that get shares because they work there. So these are all make up the shares of the business. So when you're going to share the profit, you have to give everybody based on how much ownership they own in that company. So what I've just explained to you is what you do when you buy shares. When you buy shares, you have bought ownership of a company. How does that sound? Does that make sense to you? Or do you want to take a tea break and think about it? Okay, if you say makes sense, I'll just carry on then.
Yeah.
Makes sense. Okay, lovely. Good. So we can move on now. So you're buying ownership of a company. But now let's just throw in a little thing into the mix. When you hear things like return on equity, dividends, EPS, I want us to understand the principles of these things, and then it will make absolute sense to you. Let's throw into the mix Your hospital, you're not just going to take all the money and spend it. I mean, the money we are talking about here is profit. We are assuming that when you have that £1 million, you've paid all the staff, you've done all the expenses. But then you can say, well, we don't want to take this £1 million and decide to just spend all of it, paying our dividend. We're going to acquire another hospital, or we're going to acquire a unit that does CT scan, ultrasound, MRI, and does other imaging things. So we're going to take £500,000 of this money from our profit and invest it into that area. And then we're going to pay out some money as dividends. Does that make sense? So you see that the amount that goes out as dividend is less, but as an investor, I'm not unhappy because I believe that the business is growing. And sometimes some businesses will just take all the money, like the Amazons of this world. They invest it back into the business. They'll buy a business. They do whatever they do. They want to buy back shares sometimes. So that's what happens when you buy shares. Now, to bring it back to stock market terminology, when you buy common stocks, you're buying a part of a business. Now, when you hear things like dividend, you're getting your returns, your dividends from the business. Let's say the company decides to pay out some money from their profit. That's dividend. When you hear earnings, that's a very important word. The earnings is basically the earnings, the income the company has made. So after they have done their expenses, they have done everything, this is the money they have. That's the earnings. Earnings is not equal to dividend. Earning per share, I will explain, is not equal to dividend. Can somebody tell me why, from what I've explained now, why earnings per share may not be equal to dividend? Even if you don't understand it totally, give it a go and you see it will help you to understand it better. Can somebody just raise your hand, tell me why earning per share might not be equal to dividend?
Still don't know, to be honest.
Fair enough. Okay.
I think the earning per share would be how much if you get whatever the total profit the business has made, and you divide it by the number of shares of the business, that gives you the earning per share. But the dividend is whatever they decide to pay back minus what they are kind of reinvesting into the business if they decide to.
Fantastic. Can you just for Chi and for the rest of us, just relate it back to this hospital analogy I gave?
Okay.
Might help.
So like you said, if the hospital has made £1 million in a year, so and they have 20 shareholders.
Yes.
Let's say each of the shareholder has one share. So you can say that the earning per share is £50,000.
Okay.
Yeah.
Sorry. Hold on. Let's make it a bit more. Let's break it down. Let's say the hospital makes £1 million, and there are 20 shareholders, and each of them own one share.
Yes.
So because of they own one share, you're taking 1 million, which is
and
the
dividing it by 20. Yeah.
So the earning is 1 million, and you're dividing it by the number of shares, which is 20 outstanding shares. That's what they mean by outstanding shares. So 1 million divided by 20, that gives you the earning per share. So carry on, please.
Yes. But then they might just decide, okay, we want to reinvest half of the whole thing into the business. So then they can say, okay, let's reinvest £500,000 into the business. So and then use the other 500,000 to pay as
dividend,
to pay as dividends now. Yeah. So that way the dividend would be £25,000.
I love it. Yeah. So instead of 50,000, they're getting 25,000 because obviously they didn't pay out all the money.
Yes.
Okay. Thank you so much. Yeah. Chi, feel free to let me know. Did you understand it? Which part did you understand?
So I understand the dividends aspect now.
Good.
I understand the earning per share now. I think my confusion before was earning per share. I thought it's money you also receive. So I was wondering how you can receive earning per share and receive dividends. But I understand that the earning per share is not necessarily money that you're receiving, or
Yes.
how much your investment is making per share. So I get it now.
Absolutely, that makes sense. Okay, thank you so much for explaining that, Austin, and thank you, Chief, for your contribution. So the dividend comes out from the earning per share. The dividend is a factor of the earning per share. The dividend can never be more than the earning per share, but the earning per share can be more than the dividend. And sometimes you get EPS and you don't get any dividend. Like, what's going on here? They're like, we're investing the money. If they have a better idea to invest the money, I'll say invest the money. And it's tax efficient for them, and they know that they can invest the money to get more money. So this hospital is buying an investigation center, a radiography center. Therefore, they're not paying out all their earnings as dividend. Instead, they are just going to give us part of it, or sometimes none of it. Good. All right. Now that takes me to another part where people stumble a lot. Remember, by just using hospital and the cow and the fowl and eggs, we're beginning to understand things like earnings, earning per share. Now, another area where people stumble a lot, in this hospital where there are 20 shareholders, I said shareholders, not hospital director, not CEO. Those people could be hired. They don't have to be owners. They can just be hired. They might be owners, but it's very different. You, the shareholder, the owner, and you, the shareholder, decide what happens. That's why when they go for shareholders meeting, I go and I vote. That's why there's board of directors. They are representing shareholders, and board of directors can fire the CEO because he owns the company. Now, let's say back to this hospital, there are 20 owners, and the 20 owners each own one share. Does that make sense? They own one share. Good. Now, let's assume that instead of each of them owning one share, there are 1 million shares in the hospital. They said, now, the value of this company when we started it out was £1 million. So we're going to say the value at that point when it was valued is £1 million. I know now we're making £1 million per year, but at the beginning it was £1 million. And let's say because this hospital is not on the market, so currently they just sort of like have what we call a book value. And I'll explain what book value is £1 million. The book value is £1 million. I'll scratch that. Let's just go with 5 million. I'll explain book value, £5 million. And instead of having 20 shares, so instead of 20 of us having one share per person, there are 1 million shares. So can someone do a quick math to say if we all own the same proportion of shares and there are 1 million shares, but there are only 20 of us, how many shares will each of us earn? Your exercise has started now. How many shares will each of us own, actually? So if you bust out a calculator, we don't like to do public maths because especially when it's something simple, you don't want to get it wrong. Then it will be difficult to explain to your child that they should know the basic arithmetics. So we are assuming that there are 1 million shares. Yeah, we're assuming there are 1 million shares and there are 50 people. How much? Did somebody work it out?
Is it
Oh,
50 people or 20? I thought you said 20
20,000.
people.
20 people.
Okay.
50,000.
50,000 if it's
50,000. You see, public math floors people like me, right? Despite the fact that we do it privately. Yeah, thank you for that. So there's 1 million shares outstanding now. Don't confuse this. The 1 million shares is just the value of the hospital. We put it at £5 million, 5 million, and there are 1 million shares outstanding. Now, only 20 people own shares in this hospital, and they own it equally. So that means that each of them owns 50,000 shares of that hospital. Does that make sense so far?
Yes.
Yes.
Please, if you don't understand this part, please let me know, because if you don't get it here, it will be difficult for you when we go into valuation. But I want to assume that we all understood it. Okay.
Sorry,
So
can I just ask?
please ask.
I know you're going somewhere eventually with this anyway,
Yes.
but so you started off with the initial 20 shareholders. Okay, they own one share, and then there is 1 million outstanding shares.
Yes.
and the book value of the company is £5 million.
That's correct.
Okay.
So that's another. Is that all understood? Okay.
Yeah.
Let me just clarify. So the company initially they owned just one share, so there were 20 shares, but now we're moving to a different model. We're saying they don't own 20 shares anymore. There's 1 million outstanding shares, and between all of them, they own 1 million shares. Does that make sense? Between all of them, they own 1 million shares, but each of them owns 50,000 units of that 1 million shares. Does that make sense?
Yeah.
Excellent. So whenever you hear the term shares outstanding, and I'll show you how to find this thing for any company. It's all out there. It's not difficult. Don't let people move you with jargon when they come on CNBC. In fact, if you listen to Jim, should I say his name? There's one particular analyst on CNBC. If you follow all his investment recommendations, you'll be homeless. If you do the opposite, you'll be fine. Because people sound smart, they say all these things, and there's actually an index that has tracked this particular analyst on CNBC and showing what he has been predicting to happen or talks about, and they just show that if you go the opposite way, you'll be fine. But people sound smart when they say outstanding shares, book value, shares outstanding, earning per share. But once you understand the fundamentals, you become a bit of I'll not say a dangerous investor, but you become a safer investor. You're dangerous to Mr. Market, who I'll introduce to you later. But in yourself, you know what you're doing, you know where you're going. It doesn't mean you not miss it sometimes, but you will know where you missed it. So we've established some things now. There are 1 million shares, there are 20 shareholders, and there are 20 shareholders who each own 50,000 shares. Good. Now, the next thing we're going to do, we said earning per share. We said the earnings of this company. Should we call it Maryjane Specialist Hospital? They're earning £1 million per year. If Maryjane is still there, please give us some percentage of this company. We're very interested. So £1 million annually, annual revenue. I'm just going to leave £1 million. So there are 20 shareholders. Okay. So far, so good. We know what the earnings are. We know where it comes from. We know how to calculate earning per share because it's basically the number of shares is the denominator and the earnings is the So the number on top is the earnings, and then the number below is the number of shares, basically number of shares outstanding. Now, just to test if we've understood this thing, because I don't want us to rush. I want us to brick by brick understand what we're doing. If we really understand this thing now, if the book value of this company is £5 million, and I'll come back to book value and how to calculate it. If the value of Maryjane Specialist Hospital, the book value, so if you look at the value of the assets, the equipment they have, the building alone is 1 million, and then the equipment they have is what, 2 million. I mean, if you break it down and sell everything immediately, the amount of money you can get right now is what we call book value. So the book value is £5 million. I've just made it a bit simplified, but that's basically what book value is. The book value is £5 million, but there are 1 million shares outstanding. So what would be the value of one share? The book value of one share.
So £5.
£5.
£5. I like the way it was done so quickly and easily. Does anyone not understand how we got to £5?
Yes, I don't.
Please feel free to ask. That's good. Thank you. Who was that? I didn't quite get it. I was looking at the PowerPoint.
Namdi.
Namdi, good. Okay, good. Excellent. So let's go back again to it. Now we're saying that the value of this company, the book value, do you understand book value, Namdi?
Yes.
Good. So you understand book value. So that's good. Now the book value is £5 million. What the company is worth as it is now, not what we hope it to be in the future. If accountants we are to come in and just value everything, value business valuation, assets, brand, everything all together, is £5 million. That's the book value. That's what it is at the moment. But there are 1 million shares outstanding. Do you understand that bit? There are 1 million shares Remember, those 20 people each own 50,000 shares because because it's easier to, if you have 1 million shares, it's easier for me to sell you one and still hold some than if I just have one share. So there are 1 million shares outstanding. So the book value of each of the shares is you take the value of that company and divide it by the number of shares.
Okay, so it's £5. Yeah, so 5 million by 1 million. Okay.
Exactly. Okay. Another place to look at, another way to look at it is, I know people will say that the whole is not basically a sum of the parts, but another way to look at it is that if I don't want to leave this hospital now because the hospital analogy is getting home, but if we own something, and let's say we own a property. Now let's say the hospital for a minute. We own the property, and this property is worth £5 million. The property is £5 million. The value of the property at the moment is £5 million, but you own half of it and I own half of it. So there are only 2 shares outstanding. Let's just say you own half of it, I own half of it. There are 2 shares outstanding. 1 share of that property is worth 500 because the property is £1 million. 1 share is 500. The other share is 500,000. But when it comes to businesses, they're able to break it down into multiple shares so that people can buy at different amounts at different times and for ease of transaction as well. So that's what it is. When it comes to this particular business, the hospital, the book value is £5 million. That's the current book value. And the outstanding shares is 1 million. That means that each share is worth how much? £5, right? Is that all right, Namdi?
Yes, I got it.
Right.
Thank you.
So that's the price. Now, next time you hear book value, this is what it means. The book value of that share is £5. So when I say to people, if you're not going to buy Maryjane's hospital at 20 million, let's just say Maryjane comes to you and say, okay, let's not use 20 million. Let's just say Maryjane comes to you and say, will you buy my hospital? The book value of the hospital is how much? Please help me out here. How much is the book value of the hospital?
5 million.
5 million. And Maryjane comes to you and says, thank you. And Maryjane comes to you and say, I want to sell it for £50 million now. Will you buy it?
No.
That's a lot more than the book value.
It's overvalued, yeah.
Yeah, I mean, except you think, oh, Maryjane's hospital is about to discover the cure for cancer, HIV, and every other disease that has not been cured, and I just want to buy it. So maybe they'll get a patent and I'll own it. If that's not the, and even if that's the case, you're not sure. So if that's not the case, you think, why am I paying 10 times? You soon see where this 10 times will come in now. Why am I paying 10 times for it? Because the book value is £5 million. All right. Now, if you're not going to buy for 50 million, does it make sense to buy the shares of the company for £50?
No.
No.
Some people are doing maths now. So you not buy for £50. Okay.
Because
Carry on.
currently the share is £5, isn't it? Each share costs £5, isn't it?
It's
Exactly.
So £50. So you're still going to buy 10 times what it's worth. So you're indirectly buying it at the price she's trying to sell it.
That's
10%.
a very good, important point. But somebody says a very key word now. Who was that said cost and what? Do you mind? Yeah, do you mind telling us what you mean by cost and what?
Because it's what each share is. Each share is worth £5.
Mm-hmm.
So buying it at £10 means that you're buying it at £50 means that you're buying it like 10 times what it is worth, really. So it's obviously overvalued.
Excellent. Now I'll explain what let me just throw some more light. So what Austin is saying is the book value is £5, but somebody is selling it for £50. So it's costing £50. That's the cost to buy it. But the value, according to the intrinsic value, the book value. Intrinsic value is more than book value, but book value is a good place to start. The book value is £5, which is 5 million. why I started from this angle is that it should make you realize that when you're buying a company, it doesn't matter if you're selling it for $50, you have to think about it from, but what does that $50 really mean? For you to know that, you have to know the shares outstanding, and you need to know the book value. Thankfully, when we started valuing stocks, you had to do these things manually. Thankfully, you can get all these things online. You can actually get the numbers laid out for you. But if you understand the principles, then when you see the number, you can make sense of it. So this company, this Maryjane Specialist Hospital, might be out there, and there might be people willing to pay 50 million for it. That's the cost. There might be people happy to pay 50 million for it. 10 people, 20 people, VCs, venture capitalists, they've come in with a lot of money from the US. They want to pay 50 million for it. But that is just the price. That is the price. The price is not the value. The price is determined by the market. The market is a voting machine, not a weighing machine. The market is just determining this is the price of this stock, not necessarily the value. Does that make sense? So the value, according to what we determine here, is that the book value is £5 million for all the shares. And because there are 1 million shares there, each of those shares, one by one, is £5. So if somebody comes to sell it to me at £50, I'm going to say, hang on, why should I buy at £50? What are other hospitals selling for? And what is my guarantee that this hospital, if I buy it at £50, that means I'm expecting that the hospital is going to go from £5 million to £50 million, and even better in the future, because they are buying it at 10 times the book value. So that leads me to the difference between price, book value, and the price of the shares. So if you go to the stock market, sometimes you see a share. I don't know why I keep calling Tesla, because that's the one that was so popular and people keep making that mistake. You go to the market and you see a share like Tesla. You can just Google today, just type TSLA. You go to Google, if you type TSLA share price, Tesla, you see that today is currently at $230. If you type TSLA share price, it will tell you $230. Now, if you look on the left side, you start seeing some other numbers like PE ratio, which is 64, which I'll come to. I don't want to jump the gun. The PE ratio is 64. Now, when you come back to Maryjane's hospital, the price, let's just say the price they're selling it for is £50 million. So the book value is £5 million, but they're selling it for £50 million. That means that there's a difference between the price and the book value. So the book value, or rather the price, is 10 times the book value. Does that make sense so far?
Yes.
Okay.
Yes.
So that's what we call price to book ratio. Price to book ratio. You can write that down, but you don't have to bother too much because I've included it in the pack I sent to you. But that's price to book ratio. What is the price that is selling in the market? Is the financial metric. It compares the company's market value to its book value. So it's calculated by dividing a company's current stock price, what is selling in the market, by its book value per share. Again, remember, we're going to have 4 weeks follow-up. We'll be able to check these things, practicalize them, do them with stocks. But I just wanted to understand that basic principle. This is where book value comes from. And that's why there can be a difference between the book value of a company and the price. Most times the price, when I come in and I see a company, okay, let me give you some example. You wouldn't buy Mary's Hospital at 50 million, which is the same thing as buying £50 per share. But what if Mary came to you and there's a book value there, there's accounting and it's all checked out, and she says, nobody wants to buy my hospital. Doctors are leaving the UK. They are going to Canada, Australia, New Zealand, and Nigeria, and it's getting difficult. But you know that you can staff that hospital. You have a partner who can provide doctors and all that. You have a relationship with the doctors. And Mary is tired of the business. They want to sell it. And they come to you and say, I don't want to own this business anymore. Give me £2.5 million for the business. What do you think? Is it a good deal or is it a bad deal? Would you consider that deal at least?
I think it's a very good deal to
Yeah.
So at least consider. Yeah.
It's a good deal to consider. Okay, who else? Does anyone have a different opinion? I mean, don't worry about whether you have 2.5 million pounds in the account for now. You might, but don't worry about that. Well, I hope you found that helpful. And more importantly, I hope it helped you to see investing in a new light. This is just a small section of what we cover in the full masterclass. If you'd like me to drop more of these clips, just let me in the comments. Comment invest and share this video as well with friends who may need to hear this. And if you are ready to stop winging it and guessing, guesswork is not good for investing. If you want to learn how to become a confident investor, to learn how to invest properly, check out our Investing Readiness Scorecard with the links in the description. It will help you determine whether you're really ready to start investing and what you need to do before you even start thinking about investing to reduce the chances of you losing money. And until then, have a lovely Easter holidays and see you soon. Bye-bye.